navigating commercial real estate in 2025, seizing opportunities while dodging risk. I like that title, John. John Winick, CEO, Clark Street Capital, is our moderator. We have Tim Mazzetti, Vice Chairman of CRE at CitusAMC, Charles Krawitz, Senior VP and Head of Commercial Lending at Alliant Credit Union, Brad Salzer, President of Redstone Funding. These gentlemen are an all-star panel, and John, they know what they're talking about. So you've done a good job on this. I think this is a great way to end the year. If you would like to see this again, we do have it up on our YouTube channel under Coleman, and also it's hashtag Winick or Clark Street Capital, so feel free to do that. John, with that, I'm going to stop talking, and let's let these gentlemen tell us what we need to know in 2025.
Thank you, Bob. This is such an easy panel that we could all roll out of bed and do this, so without prompting. Excited to bring this group back for the third or fourth time. Just going to kind of start with an overview. I think you go back one slide on sentiment. You may have the wrong version of this PowerPoint, but we'll barrel through. But to start with, our friends at Situs did publish a report, and investor sentiment on commercial real estate is very positive. And certainly the last couple of months, maybe it was the election, some certain in interest rates, but sentiment has certainly turned more positive. Just want to go over a little the delinquency side. We did see a material uptick in delinquency amongst CMBS in November. You can see the overall delinquency rate is now over 6. Interesting, big disparity. Industrial is a third of 1%, and office is, I guess that's 30 times that, or 40 times, 31 times that. Office is 10.38%. That was a pretty significant spike from October. So just keep that number in mind. Roughly 6.5% of CMBS loans are considered delinquent. Now, when you go over to the banks on the next slide, this comes from all the call report data on the third quarter. The bank performance is, at this point, substantially better than CMBS, and we'll get into reasons why. But all CRE, non-owner occupied, is running at 2.07% delinquencies. Interesting spike in, Bob, you'd appreciate this, CRE owner occupied, pretty material spike from quarter to quarter, from Q2 to Q3. That's now over 1%. The other land category went up as well. One thing that's obvious here is the bank reporting on commercial real estate simply sucks, to be frank. Really all you have is 4 or 5 categories. The only property type that is really addressed in CRE is multifamily. So you don't have any data on how office is doing, etc. Now, the banks themselves that are public, they do tend to disclose some of that, but there isn't good, in my opinion, uniform reporting on commercial real estate from the banks because the categories are not granular enough. If you go to the next slide.
Hey, John, let me interrupt here. The SBA just came out with their stats. 504 delinquencies for fiscal year 24 were actually 0.85, which is interesting when I'm looking at that CRE owner occupied. So 504 stats are lower than that. And I don't know what you can do with this, but 7A, they're saying the delinquencies are right at 1%. So just put things into sort of context.
Yeah, I mean, certainly the beat goes on with higher interest rates and inflation still being stubborn. Obviously, we've gotten some relief from rates, but if you look at the 10-year Treasury, we are basically back where we were at June 30th. So there was a big reduction in the 10-year in the third quarter, and the fourth quarter has pretty much reversed that. We'll get you guys the correct slides, but there was one other thing I wanted to share with you regarding changes. So why are we seeing this disparity? Why is CMBS so much worse than banks. 6%, 6.5% versus 2%. Our esteemed Tim Mazzetti, Tim, why don't you go ahead? I don't want to steal your thunder. Is it true you actually said CMBS is the lender of last resort?
Yeah, I'm going to get in trouble with CREFC too, which is coming up here in early January down in Miami, their annual investor conference. I think the difference between CMBS and banks, the primary difference is probably overall quality of the real estate that's being lent on. There's no doubt that the reporting requirements, the transparency, the requirements for CMBS to produce monthly reports, and obviously the inability and lack of flexibility of them being able to sort of hide potential losses or potential delinquencies and defaults is an explanation for some of the significant difference between bank delinquencies and CMBS. As we all know, and Brad and Charles can speak to this a little bit later in the session here, banks have been playing footsies with their commercial real estate loans on the balance sheet, either extend and pretend, or in some cases they've requalified or qualified loans held to maturity, which means they don't need to reappraise them and they don't need to mark those to market. So if you think of CMBS that has to mark its assets to market every month and certainly report any delinquencies immediately, and then once a loan actually transfers to special servicing, you actually have 60 days to get a new appraisal. That's a big difference between banks and CMBS.
Yeah, if you go to the next slide, I'll kind of walk you through, Bill Moreland from Bank Reg Data, one of the best banking analysts. He publishes research based on compilations of the call reports. And if you go back to 5 years ago, so before CECL, once a loan was modified, it stayed in the TDR bucket essentially for life, well, until the loan matured. And so you would see in 2008 and other cycles, the restructured loan category would keep piling up and piling up and piling up. The new rules are, in my view, way too generous and not particularly transparent. Now you can take a loan that's substandard, you can modify said loan, and just 12 months later, you can upgrade that loan. If you look at the numbers for restructured loans from banks, while they've gone up a little bit, they've been able to stay relatively flat because loans are going from restructured to performing. And, there's certainly a belief from some that there could be this boomerang effect. Bill calls it the Ferris wheel, where a lot of these loans come back. Brad, this dovetails well. I know you've read in and out the Federal Reserve of, was it New York's paper on extended pretend? What happened there?
Federal Reserve of New York came out with a paper, and there was a lot of kind of, deep breaths that they were criticizing, if you will, their own banking system in some ways. And it was an interesting paper. There was some controversy around it. Is it related to big banks and small banks? But if anybody hadn't seen it, I'll be glad to get it to you. It came out in October. I thought it was fairly well done. I'm a huge follower of extend and pretend as Redstone Funding acquires mortgage debt in the secondary market, and there hadn't been a lot of it. And, the technical term I learned today, it's called playing footsies with your borrower. And there's been some of that going on. And we're talking about the methodology, which is interesting. And I'm going to kind of crystallize what I just heard a little bit. We're talking about the methodology, and I kind of concur with John's observation that bank data sucks generally, not very transparent, more like the CMBS. But here's what and it's funny because Jamie Woodwell, who I have great respect for at the MBA, just came out with their report today. And the MBA is saying that commercial mortgage delinquencies increased in the third quarter, which should be no surprise. Generally, bank delinquencies up at 124 and the CMBS up at 5.5-ish. And here's what I think we need to remember. Rates are up the highest they've been in a long time after being historically low for 15 years. And when you dovetail interest rates along with operating expenses, which we all know about, we love to talk about insurance, but wage inflation with our management companies, and then we add on what I'm seeing, particularly in my market, national in scope, but based in Tampa, one of the strongest markets in the country, we're seeing flat to negative rent growth. So that's a lot of pressure on NOI, thus value. So I'm probably in the camp that these, despite the positive news that John started with, I think we're in for a fairly challenging 2025 as it relates to financing and being able to get the proceeds out from a vintage 19 or 20 deal.
Yeah. So Brad, how do we conversationally bridge the gap from where John started with buoyancy and optimism to this kind of doom and gloom and nefarious actions that both you and Tim have alluded to that banks are taking in the marketplace? I know everyone loves to grab onto that extend and pretend moniker, but I'm not sure that's what's really happening. I mean, I think there are clearly issues with select loans in the marketplace, but by and large, lenders are smart. They're overseen by diligent and smart people. Yes, there have been exceptions, to that. But I think it's more of a kind of give and get, or at least that's certainly the approach that I have taken in the marketplace. I am not simply ignoring facts on the ground and letting things continue, along their merry way, playing footsies or anything like that. But I'm being fairly demanding of borrowers that have issues and asking them to post additional collateral, pay down loans, give increased guarantees, a whole laundry list of different credit protections in order to amicably resolve a difficult situation. So kind of going back to and I'm optimistic about where the marketplace is headed, despite issues that you've talked about, in Tampa, and there are issues in other cities, but overall, I'm fairly optimistic that 2025 is going to be a really solid year for commercial real estate.
Yeah,
Charles, I'm sorry, John. Charles, I think I can help bridge that dichotomy, call it optimism for 25 and going forward versus a little bit of the doom and gloom we felt in 24. I think the explanation is, I believe most people saw 24's hitting bottom, both in especially multifamily with a huge amount of new product that came online and certainly in some markets, which, Brad, you're seeing that in Tampa, you're seeing that in some of the high growth markets, Austin, Texas. I mean, there's a number of markets on the multifamily side that just took on more new units than they've seen in literally decades. And you combine that obviously with increases in expenses and everything else, and you've got some real problem on that sector. But I've also heard, and I listened into another webinar where the CEO of Avalon Bay, one of the largest developers of multifamily, spoke, and he talked about that huge amount of product that is going to be taken up and the slowdown in new product coming out in 25 and 26. And he sees balance returning in 25 and obviously even some rent growth starting in 26 for multifamily. The other sector that has gotten nailed is office. And again, the dichotomy that you mentioned, Charles, office hit bottom, in my view, in 24. High rates and, the work from home and, the disruption. I think we all see with better transparency and better understanding as to where rates might be in 25, regardless of what happens tomorrow with the Fed. And I also believe that people have gotten comfortable with higher for longer. I don't see the Fed doing a lot more reductions in rates in 25. You at least can put money out. And Charles, I'm assuming you look at that as well, that you've got more certainty, not just in where interest rates will be, but where values will be.
Yeah,
so
and
I think
I
that
think
explains why there's optimism. We also believe that there's still going to be a lot of distress in 25 and 26.
I think a lot of the headlines, which kind of dictates, I think, our general perception and mood has been around office. And Tim, to your point, far fewer Class A deliveries, the Class A marketplace starting to really tighten up. The numbers that I've seen is that vacancies have kind of hit a high water mark of about 19% across the entire office space, and it's going to be headed down. I've seen firsthand tenants significantly shrink in their square footage, only to come to the conclusion that that wasn't the best move, and now they're starting to expand out and take back space. And then obviously there's the return to market push, to office push that's been going on as well. And so as those headlines become less glaring, I think that will lead to general buoyancy in the overall marketplace. One area that I am very concerned about is workforce housing. We talk a lot about the higher end marketplace and the overbuilding and more glamorous areas of the country, but I'm also, I think a lot about workforce housing, and particularly if the Trump administration goes ahead with the deportations as they've outlined. That will have a negative impact for sure on C quality assets.
We do have a poll question. I think some of you have already voted. This is a question we asked 6 months ago, so I'm kind of trying to see how sentiments has changed. Commercial real estate 25 and beyond, is it a category 5 or a mild storm? I know some of you have already voted. Let's give it a second before we close it. When we did this question back in, would have been May, basically 2/3 said more than a mild storm, 1/3 said a mild storm, nobody said no storm. And you can kind of see today, the sample size is a little small, but more and more there's a sense that we're not going to see anything too bad at this point. What do you all think?
Yeah, I mean, I would caveat that with any exogenous event, but assuming that the economy continues to chug along, as is the hope and expectation in 25, certainly it has all indications that soft landing, or whatever you want to call it, we're going to continue to see growth here in the United States. Europe and elsewhere may be a different story. Then I believe that 25 bodes well for people who have dry capital and are looking to put it out, whether it's Brad looking for distress opportunities or Charles looking to put new money out on the balance sheet, and even CMBS. I mean, we're seeing some very big pickup in securitization, CLOs and CMBS. So I view 25, again, there's a lot of those issues in multifamily and office that have to come home to roost. If there was an extension, those need to be cleaned up and fixed, and even into 26, that maturity wall. But also see, again, that dichotomy that Charles referenced, a more exciting and confident capital provider market to be able to put new capital out.
Yeah, I mean, we did touch on the new election. And certainly a new administration is going to bring some changes. Some will be positive for commercial real estate. Some will be less positive. Panel, what do you all think? I mean, what do you think will be positive? I mean, Charles brought up workforce housing as being a negative. What do you all think?
Well, I'm just going to back up a little bit. I mean, there is a lot of dry powder on the sidelines. And one of my concerns, while there is dry powder and it wants to go to work, it's not going to be at the rates we've seen historically, the last 15 years. So that is going to be a change, but that money's there. Then the question I'm asking is, what's that going to do to the equity? I mean, if you need to fill a gap, is equity going to stay into play? Are they worn out? Are they going to get totally diluted and new equity is going to come in and see the opportunity? So I generally, and by the way, multifamily is just a supply demand issue that's going to fix itself if we study the demographic focus. So, naturally, because it was the hot product type, the multifamily in the Smile States, the Sun Belt was overbuilt, and it's soft now, and it's going to recover. It's just a timing issue. And then we got to talk about retail. I mean, retail is the soup du jour, the food type du jour, it seems. And it wasn't that long ago that it was the office of, the bad word was retail, and now it's office. So, and I am seeing more positivity towards office. Charles talked about it. I think it's fascinating that some of those tenants that thought they needed a smaller footprint have now decided their old footprint wasn't so bad. And right, as we move back to return to office, and I go back to John, you sitting in Chicago, what would Sam Zell say? I mean, maybe now's the time to absolutely go into office when I can buy debt in Chicago at 50 cents on the dollar.
Sam had a tendency of saying one thing and doing the opposite.
Yeah.
But, be that as it may, knowing the macro outlook for different property types and for the marketplace as a whole, obviously very, very important. But real estate is a locally opportunistic business, has always been. And I am sure there are going to be lots of opportunities in build to rent housing as a way of addressing the housing shortage. I think there's going to be plenty of opportunities with reshoring of manufacturing. We have to look at kind of what's going on and then translate it to where there's local opportunities to be had. Self-storage has arguably been overbuilt in a lot of marketplaces, but certainly not in all marketplaces. And Americans have shown a propensity to own stuff, lots of stuff, and need somewhere to put it. And where housing becomes a little bit more challenged, maybe that extra room needs to have a body in it rather than Tupperware is full of memories. But I think ports, one area we're not talking about yet is the ports, and if we're not importing as many goods, what happens to the industrial space somewhere like the Inland Empire that's in service to the ports? How does that get utilized or potentially repurposed into something else? So lots of different dynamics at play, but again, locally opportunistic.
I mean, the immediate impact of the Trump election was rates spiked. And so at least for the time being, higher for longer seems higher for longer. Yeah,
again, if you really look at the history and Trump's first administration in 2016, a lot of his tweaks, if you will, or tweets or social, whatever his social platform, is more shock approach than anything else. At the end of the day, when you really consider what can be done, like the deportations and other things he's talking about and tariffs across the board, it strikes me as very few are actually going to get done. And if they do get done, it's going to take a while. And so there was a really interesting article today about the Fed and what they're going to do tomorrow. I believe they're going to reduce rates 25 bips just so there's no surprise in the marketplace, because that's what they've talked about. But that then they're not going to do much in the first half of next year. And what was very interesting across several of the Fed members was that they all said, look, we are not in the business of speculating what may happen with the new administration. We need to allow the dust to settle, see what happens in the first quarter, second quarter, and decide and make our decisions regarding rates then. But I do believe, to your point, John, rates are going to be higher for longer, regardless of whether Trump's tariffs and other activities, reduction in taxes, are going to be inflationary or not. We really need to see what happens in the first half of the year to determine better.
A great time to pull up the poll question on interest rates while we're doing that. Charles, I know we asked this question for you 6 months ago. How are you underwriting new commercial real estate loans? Have your underwrite standards in the past year gotten tighter, looser, etc.?
So we are, again, opportunistic, John. We're looking at the local dynamics. Are there multiple demand factors for a property? What does the supply picture look like going forward? And making sound decisions on individual assets. Tim brought it up earlier. Properties are under a lot of pressure from increased insurance costs and taxes and labor. It's increasingly difficult to do deals that have thin debt service coverage, knowing that probably within a year's time, there's going to be a covenant violation that happens on those deals. So looking for sufficient padding, being cognizant of the overall marketplace and making prudent individual loan decisions. And we'll do roughly 550 million, or we're planning to, in 2025, which is about the same number we did this past year. We source our deals through commercial mortgage brokers around the country. We get to see a lot of different opportunities, and fortunately, we can be selective.
Charles, let me ask you a quick question. What kind of debt do you put out? Is it mostly floating rate, maybe shorter term, 3 to 5 years?
No. So I tend, Tim, to lend on stabilized assets or nearly stabilized assets, sometimes where there is not a long history of stabilized cash flow. We will look for some credit enhancements. Typically, that comes in the form of a guarantee or some kind of springing recourse. And also oftentimes structuring loans where there is a very prescriptive way to earn out additional funds once that property has shown the proper amount of positive operating results.
Got it.
So typically 5-year deals these days.
How are we all handling appraisals these days? I know, there was so much, it was so difficult to get our arms around because the trades weren't happening, the transactions weren't happening, the volume was down. How heavily are you relying on appraisals, Charles?
We order appraisals from some of the largest appraisal shops in the country. We certainly go through them diligently and have discussions where we find to be areas of I wouldn't say disagreement, but of inquiry to try to get on the same page. But yeah, an appraisal definitely is relevant to us, and we have confidence in the firms that we work with.
Yeah, it's funny you mentioned that, Brad. On the CMBS side, when we come in as special servicer, again, typically a regulatory requirement in the PSA is that we get an independent third-party appraisal, usually within 60, at most 90 days after a formal transfer. I'll be honest with you, especially on some of the more difficult, challenging markets with office, we tend to go to the local brokers and get BVOs, get an opinion of value that we can then use when we review the appraisal, because we still don't have that much confidence in the appraisal, because appraisal is a point in time looking back. We really need to understand where we think the value is today, given the current market dynamics. Maybe a little bit different than just a down appraisal. But at the end of the day, we need to take that appraisal.
I like the check and balance. I think that's a great strategy for underwriting.
Well, especially in a difficult market like downtown LA or San Francisco, or even certain parts of New York, where the local broker, is going to have a much better feel for where that asset, how it's positioned and what its value is than just an appraiser. And to your point, there's still not a lot of comps out there. I mean, volume has picked up, but it's still very much depressed.
Yeah. Brad, what's as you could see from the survey, pretty much everyone thinks they're going to lower rates tomorrow. I think the prediction markets were like 95%, so that's fairly consistent with that. Brad, what do you see going on in the distressed market? Are buyers and sellers getting more realistic, or is there still a lot of deals not happening?
I still think that there's this. I think we've got movement now, John, and you said it a couple of years ago, and I still quote you. That the market needed to capitulate to higher rates, and it's taken them, a while to accept the fact that we weren't going to start dropping rates to where we were and find this new normal, this neutral rate. And I think 5% probably is not an unreasonable rate. I talked to a national mortgage broker yesterday, and this was kind of very interesting. He was telling me, I was telling him, that we're doing more originations now, more bridge financing because the secondary has been slower. And he wanted me to quote on a deal. And he said that the efficiency with which private equity or non-bank lenders can move is so much better that many of his borrowers are looking for non-bank lenders to put the bridge on for 24 months because you don't have to go through some of the same brain damage maybe that the banks, particularly now, are requiring. But the bid ask is still fairly wide in the secondary. But I think as we really accept higher for longer, we're going to start, to use your word, capitulating, and we'll start to see more trades and more action, particularly after, 2 years of keeping these loans on the books and there hadn't been any significant increase in value or refinance options. So we've seen the market picking up this last year end. It's been a very busy year end for us compared to last year. I'm not sure if that's a function of the banks freeing up or if it's just a function of year end cleaning. We'll find out in the first quarter.
Yeah, in our experience, we're actually taking bids today on a $210 million portfolio, mostly in the Dallas area. And it does seem like on initial calls with banks, when we discuss pricing or we ask their expectations, it's definitely more realistic. On that note, one thing I could say is the housing market in Dallas, for example, which is really ground zero for home construction in the U.S. right now. It does seem to me that there's limitless demand for housing, particularly in that like $300,000 to $800,000 sector. I've talked to every bank that lends on homes and lends to home builders in Dallas, and I haven't spoke to a bear yet.
Yeah, the issue I think is affordability. And there was an article today in the Wall Street Journal about affordability is becoming a problem in major cities across Europe, which was not the case. And again, it's the cost of construction, it's the cost of debt, it's the fact that inflation has been higher over the last 3 or 4 years than increases in wages. There's a lot of downward pressure in the ability for especially new homeowners to be able to buy and afford a home. Which is why what's interesting again, a property type that we haven't spoken about, but that is getting a lot of attention again by institutional investors is build for rent and single family homes for rent. Because again, people want to have that backyard. They want to be in a neighborhood with other families. They want to have a home as opposed to an apartment, and they can't afford to buy. And therefore, these build for rent and single family homes for rent have gotten quite popular.
Yeah, especially in areas where you can build homes in that $500K price point. Built to rent typically is at the lower end of the market. Tim, curious about your thoughts. Wells Fargo is pretty much getting out of the vast majority of its CMBS servicing. What's going on over there? It does seem like more banks don't want to be in the servicing business. Now, we saw it on the residential side, and that's been going on for 15 years. Now we're starting to see on the commercial side. What was Wells' thought there?
I think it's a combination of a line of business that is not really part of their core deliverables. If you think of a Wells Fargo or a PNC, which owns Midland or KeyBank, or any of the large banks, JP Morgan, Citi, et cetera, their business is obviously deploying capital and making a return on that capital, however they may deploy it. And if you look at Wells Fargo, they built a huge, I think the largest of the what I call the big three, Midland, KeyBank, and Wells, and they do have an oligopoly in the CMBS MSR side, the mortgage servicing rights, which they buy and have for over 20 years. It's actually when I was with Midland, while we sold the PNC in the late 90s, we realized that we would not be able to compete if we didn't have a balance sheet and a low cost of funds. The problem is with changes after 2008 and the great financial crisis and new risk-based capital requirements, even related to MSRs, those banks need to market those MSRs every quarter. And there is some volatility, especially with increases in delinquencies in the value of those MSRs, and obviously with the increases in interest rates. I have a sneaky feeling that Wells decided, because they're not selling their agency book, their Fannie, their Freddie, their FHA book. They're not getting out of that business. So they're not totally getting out of service. And they're still one of the largest balance sheet CRE lenders in the business. That is all staying in place. What they're really selling is their, as you pointed out, their CMBS book. And there's a lot of people supporting that. I think that's the driving reason behind it. It is just not core to their key businesses, and they felt it might be a good time with interest rates up. Obviously, that business is earning a lot of interest on deposits and is probably quite profitable for anyone who buys it. And I believe Trimont is the one who is going to be taking it down in Q1 of 25. But I don't think it was core to their overall business strategy. And so they felt it was a good time to sell it.
Yeah, the CEO told me a month ago that he couldn't understand why a bank of our size would want to service an asset we don't own. So that does seem to be the philosophy. Switching back to originations, we kind of touched on private credit a little bit. Charles, I'm curious, in your world, how often is a private lender a competitor, or are they just doing something so different from what you might do?
So, sorry, I only told part of the story earlier about our sourcing of stabilized deals from commercial mortgage brokers. We actually have a fairly robust business that we have developed over the last 7 years to provide note-on-note financing in conjunction with debt funds. And so we work with about 10 different debt funds, looking to expand that number, looking to make this a larger portion of our business. We really like working with people that have expertise in the bridge and in construction spaces, that have large loan portfolios, assets under management that far exceed those that we have in our commercial book, that really know, have longstanding relationships with borrowers, really know the marketplaces that they operate in. And we just absolutely love having those folks as our partners in providing liquidity to the marketplace.
And Charles, is your loan-on-loan program very similar to a traditional warehouse line?
It is not. It's usually an alternative to a warehouse line. A lot of these debt funds have their warehouse lines, and for whatever reason, the construct of those lines don't fit the opportunity at hand. So ours is very customized, very, I guess, artisanal, if you will, in nature.
Well, that's one thing I point.
You and I should talk, given that the vast majority of our clients are bridge lenders and floating rate lenders who use traditional warehouse lines.
I will tag along with you at CREFC, Tim.
Well, I mean, to what Charles raised an interesting point. I mean, people bring up this private credit versus banks as if they're in direct competition to each other. I mean, on any private credit deal, a bank is typically lending 70% or something like that of the dollars. So private credit and banks, for the most part, usually work together, like Charles described.
I've heard it
Yeah,
described as frenemies. They're frenemies.
And we really
Yeah,
like to
like
work
we
with
are,
those
Brad.
who are
Right.
who are also equity owners themselves, property owners themselves in a particular niche. So there's one outfit, without naming names, that is really, really adept at owning and operating hospitality properties. I would never venture into that asset class on a construction or bridge basis because I just don't have that wherewithal. And not only do they have the wherewithal as a lender, they have the wherewithal as an owner operator.
That's a very good point.
So are we
And a great
seeing
combination.
so are we seeing transaction volume pick up from commercial real estate? I mean, one thing we saw is when rates dropped, some deals started to happen, and then obviously rates went the wrong direction. But it does seem like we're seeing some more transaction activity. What do
Well,
y'all
and
think?
John, just dovetailing on that, just today, Fitch Ratings came out with a sector outlook for banking from deteriorating to neutral for 2024 to 2025, moving into 2025 for banking. So I do think the banks are getting their footing again, is my observation. And after withdrawing, I heard Victor Catalog this week say that bank lending was down 43% from 22 to 23. I mean, and we, I don't know what the numbers are, but it's significant. And I think they're coming back in fairly strongly. I'd be curious
we're
what you guys
definitely-
are seeing.
We're definitely seeing that across our specter of clients, again, which are primarily private equity, global asset management firms, but we do have a number of insurance companies and banks. And there's no doubt about it that capital is being deployed. And I have spent the last couple of weeks, as has other folks in our firm, talking to our clients about what they see for 25, just for budget purposes, et cetera. And pretty much everyone we have spoken to is expecting to increase their allocation for 2025 for new loans.
Well,
Yeah, and I think
transaction-
it's I said earlier, I'm going to probably be flat year over year, and that's really because the competition's coming back. The competition's coming back in force.
And you're
it's-
just a sandbagger, Charles.
As long as my boss is not on the call, Tim. No. No, I just think life companies, I think banks, I think CMBS are all going to be back in force in the marketplace, and finding the opportunities that I want will become more challenging. So I'm going to work
Absolutely.
a lot harder to achieve the same volume that I did last year.
Well, and just today I saw, for the first time ever, credit unions have acquired 20 banks this past year. I mean, a record number. We're seeing them. I see both sides of it, particularly in Florida, the Florida Bankers Association has been resisting the entry and the continued deluge of credit unions. But yet those same bankers will sell to the credit unions because the multiples they're getting. So you probably don't see much competition, Charles, from credit unions, but they're out there. We just had a deal 2 weeks ago, refied by a credit union, when candidly, 5 years ago, we thought they were a lender of last resort.
Yeah, but so explain that, Charles or Brad. Why are credit unions being viewed, or why are they being more aggressive than banks? Just stronger balance sheets overall?
Well, they're not as regulated. I mean, first of all, they're not as regulated. I mean, the NCUA as a regulator it's basically high school football versus the NFL. I mean, it's just a completely different regulatory environment. Not to pick on Charles, but
no, I would argue that is harsh, and it's a nice soundbite, but it's not reality. Credit unions have diligent and attentive oversight through the NCUA, unquestionably.
But they have favorable federal tax treatment that gives them, I think, their most competitive advantage, and that's where we've seen them really proliferate and move in from the consumer space into commercial space in a significant way. I mean, I've seen it significantly because they're the exit for many of our credits.
Yeah, I think I think there's CUSOs, credit union service organizations. There's kind of the pooling of knowledge and resources and wherewithal that have allowed credit unions to increasingly lend in commercial real estate without being that lender of last resort that Brad referenced. For sure,
Yeah.
there's more collective capabilities in the credit union space. And look, I have a very specialized team that originates, nationwide and adheres to the most stringent of sourcing and underwriting and portfolio management and workout practices. And I sell participations to other credit unions. So there's ways that other credit unions can avail the expertise that I've developed at Alliant over the last 7 years to their advantage as well. It's a very collective and cooperative space.
That's interesting.
Well, let's talk about office. And then we touched on it earlier. I mean, I guess there's two things. There's a bottom with respect to vacancy, and then there's obviously a bottom with respect to sales of office buildings. We looked at a deal several months ago, and it was clear that that market, and it wasn't a small market, had not had the market-changing sale of an office building downtown. So I do think there's still some of that needs to flush out, but certainly we're further along than we were before. What do you all think? Are we at a bottom on office?
Yeah, I absolutely believe so for two reasons. The return to office momentum has picked up. Was it Amazon that basically said that by the first of the year, they need to have people back in the office at least 4 days a week? And Amazon is a huge user of space. But there's a number of folks that are asking people to come back. And ironically, a lot of the younger generation want to be in the office because they recognize that their upward mobility and their career options are limited if they continue to work from home. I think, Charles, you were the one who said it, that folks are maybe questioning their downsizing that happened over the last 18, 24 months since the work from home disruption occurred. But the other piece of the puzzle that's happening, and again, I look at what happened with malls and retail that you referenced, Brad, 15 years ago after the great financial crisis and the digital disruption. A lot of those secondary and tertiary malls are no longer there. They've been either redeveloped, knocked down, or turned into other things. Now, CBRE came out with a fascinating study, even though it's only 1.7 or 2% of the entire office, but that is as much, that 2% is the number of office buildings that are being redeployed into multifamily. And again, you mentioned it. One of the biggest issues we have across this country is availability of affordable housing. And so in cahoots with many cities and towns, I think you're going to see a lot of office being redeveloped, or in some cases just completely knocked down. So, it's the have and have not, similar to what happened with malls. It's going to take a while. So to answer the question, John, no doubt in my mind, we've hit bottom. Rates, even if they're higher for longer, again, we have more transparency. We have a better view as to value. There are some office buildings, and we talked about this on our prep call. If you're equity in that office building and there's no light at the end of your tunnel, there's no way you're going to put more equity in. And so your options, if we're as a special servicer, is either liquidate that or find someone who's willing to put more equity in redeveloping that property. If it's a B or A quality property, then I think your options are much better.
We talked about on the call, Charles, you mentioned that more borrowers are running out of gas on deals that aren't working, and they're kind of wiping their hands clean more frequently.
Yeah, so capitulation definitely is something that we're up against. First round of workouts came when rates started moving up, and borrowers were flush with cash from a lot of success that they had previously, and they were willing to pay down loans and right-size loans. And then 6 months later, interest rates had not moved down, and those same borrowers had less money in their pocket, but still some. And they were able to find a way of perhaps posting escrows with the hope that they could get this money back if the property performed in 6 months' time. And they were willing to kind of take that bet. And if it didn't, that money would be on escrow and used to pay down the loan. So they were willing to take that bet. Now we're kind of at the third round. And increasingly, we are seeing people saying, well intended, but they don't have anything else left, to put into the deal. And even though there may be a low interest rate associated with that loan, even though there may be demonstrable equity in that loan, they just, the only exit is to put it on the market and sell it. And so I think we'll see more transactional activity because of that.
Yeah, I was looking at the CMBS delinquency data again, and I mean, Tim, maybe you could shed some light. Industrial's at 32 basis points. Have you ever seen a property type do so much better from all others? I mean, why isn't industrial impacted by higher rates? I mean, it's a head scratcher that you're at industrial 0.32%. The next one is 4%. So I mean, why is industrial not seem to be impacted by higher rates?
Well, industrial, as we all know, has been enjoying a wonderful run and continues in many cases across all different types of industrial, given what's going on with the big box and the need for additional space, whether it's for computing power or what have you. But I also think the sample size for industrial in CMBS is much smaller. If you look at CMBS historically, office and retail have always been the largest percentage of loans originated for CMBS, with hospitality probably close third, and then multifamily and industrial, which are viewed much more attractively by banks and insurance companies and what have you. Again, CMBS gets a smaller shot at making loans for those, or if they do make loans for those, it's usually not the top quality assets, which would actually be contrary to what you're seeing as such a low delinquency rate. I just think there's a smaller sample size in industrial and CMBS, and overall industrial is doing well. I think if you go back historically, multifamily was the darling of CMBS, which is why they were always looking for it. They had trouble competing with the agencies. And that delinquency rate for multifamily historically in CMBS was also below 1%, in the good days. Office has been disrupted. It's the same as malls. I mean, we're going to have to work through this for many years. We're seeing trouble with office and the wave of maturity and extensions that have happened in the last few years, hitting in 25 and 26 and even in 27. And I think we're going to be dealing with office, regardless of the movement of back to office. There are just some office buildings that don't have it shot.
Yeah, interestingly, that's I think at the crux of it right there, Tim, is that they're just obsolete offices. But on the heels of Amazon's proclamation of return to office, in the September 20th Wall Street Journal, 80% of CEOs that they polled said that people would be full-time back in the office in the next 5 years. So I do think that there's some opportunity for the right office, as Charles continues to refer to, and he's absolutely right. I mean, it's not just a market, it's a sub-market. So yeah, if we're doing the right thing, there's opportunity there, but some of it's going to be obsolete and there's no hope.
What we're not talking about is, and look at what, again, these are just headlines, which I don't pay a lot of attention to, but look at what Musk and Vivachwame, or whatever his name is, are doing with Doge, the Department of Efficiency. They're requiring people to come back to the office as a way to cut headcount. And I have no doubt that Amazon may be doing something similar. There's a lot of people who are basically not going to want to do that and are going to quit and go look for another job. And the one thing we did not talk about, but this is something that for a future one, John, AI, and how that's going to disrupt the job environment, including for white collar jobs, which are primarily the ones who use office space. If you look at where AI is going and machine learning, there's going to be a lot less need for analysts and junior analysts and what have you. And it's going to be interesting. There's a lot of interesting longer term plays that we need to look at that might affect office.
I'm just trying to get through 24, Tim.
What? You've only got 2 weeks, my friend.
I
Well,
know,
Tim,
that's a good thing.
AI is very much in the headlines with the pending port strike as well, I believe, that foreign ports have completely automated it. So there's a guy sitting behind a screen versus a ton of longshoremen, out there moving around boxes. And
Yeah, I think that's
a
gonna
lot of
that's
that's
gonna
AI.
have an effect, no doubt about it.
Yeah. Any questions from the audience?
I have a
Bob, do you
question
want?
for you, John.
Go ahead.
I don't know if this is on your radar, but I'm hearing a lot of chatter about opportunity zones. Today, SBA published a 62-page Federal Register notice. I didn't read it. What are there opportunities for lenders in those special hub zone opportunity zones? Do you hear anything about that lenders should be aware of?
Well, I think that's a specialty lending niche, if you will.
Right.
Same thing with EB5. You see capital being deployed, especially in EB5 and the opportunity zones, but you really have to study that program and understand it to take advantage of it. And it's definitely not mainline. Is it, Charles? Do you see much?
It's interesting. I would see it probably through our debt fund partners, and I have not seen it. So very, very niche.
A lot of talk about
But
it.
Tim, once you make some introductions for me at CREFC, maybe I'll know more about it.
Absolutely.
Anything else, Bob?
Something was really weird in the first of all, I see an increase in the 7, 8 to 10 million, which I don't think impacts this discussion too much. However, I did see a line that said there's actually came from Project 2025, which I know is discredited, but there was a line in there of allowing government guarantees up to $50 million for manufacturing facilities. Any thoughts about that? If we had 7A or 504 going to $50 million, how that would impact this market?
I mean, it certainly immediately it certainly would allow banks to do those projects without finding participants, because the guaranteed nature will allow you to do bigger deals. But it'll be interesting. It's not clear what direction this administration is going to go on some of these issues, and I guess that's what's going to make it fun.
Any other questions, Anna, that we have in the queue?
Nope, none have come through.
John, what are you thinking about for 2025 in topics? First of all, I love this topic. I love this panel. You guys are awesome.
Well, we'll bring this group back in 6 months.
Absolutely.
I think we're going to do another banking one after the bank earnings in January. So circa, end of January, early February, and probably bring the CNI panel back, and probably.
I'm sorry, did you say senile panel back?
CNI.
Perhaps the audience might have some topics they could email into Bob or John. And,
Absolutely.
And we've been toying around with doing something on residential mortgage lending, but haven't done that one yet. But anyway, well, thanks for attending. Bob, anything you want to sign us off?
Gentlemen, thank you very much. Everyone, thanks for joining us. Happy holidays, Merry Christmas, Happy New Year. See you next year.
Happy holidays all.
Thanks, everybody.
Thank you, John.
Thank you.
See you.